Let's talk money.
Welcome back. You're watching the New Year special edition of Let's Talk Money. And once again, we wish all of our viewers a very, very happy 2025. Now we have spent some time recapping the key mutual fund trends of 2024. It is now time for action. Which are the funds and maybe even the star fund managers to watch out for in this new year 2025? We have Kaustubh Belapurkar of Morningstar here with us in the studio, as well as Feroze Azeez of Anand Rathi Private Wealth. So now is the hottest part. What viewers really want to know, gentlemen, in terms of, what to do, are the funds to track, the fund managers to track. So Feroze, I'm going to come to you first. Let's start by setting some house rules, in place, some ground rules in terms of how we need to evaluate and look at our equity fund portfolio as this new year kicks in. So let's start with the basics.
Yes, Surabhi, I think that's very important. If you're choosing a scheme, first you have to choose a category. Before you choose the category, you have to choose the asset class. So markets become a fundamental pillar or a building block of a mutual fund portfolio. Now, markets are into three parts. We look at it like this, right or wrong, I don't know. Short term, there is a separate barometer. For medium term, market earnings or stock earnings or company earnings will decide medium term, and economy will determine the long term market trend. If you look at the short term barometers, we look at 5 short term barometers, which tells us whether it's time to be very scared or not be too scared. Should we put lump sum or STP? That short-term barometers help us get some clarity. There, I would say we are 8 on 10, even on short-term barometers. Out of the 5 barometers, 4 of my barometers are showing that market is not going to show a catastrophic fall. Okay, we can go completely wrong, but that's what it shows. Perhaps we might be right. Now coming to the earnings bit. The perception of earnings being bad is very high. When I'm looking at people, they're cribbing about earnings, but the last quarter Nifty earnings is 8.3% growth. First quarter was 4.3, second quarter was 8. The full half year, not full, it's an oxymoron, half year is almost about 6.9% growth. But in the small cap space, last quarter we have seen degrowth. Earnings have been marginally disappointing, not as disappointing, so medium term is okay. Long term, we look at 9 variables, macroeconomic variables, out of that 1 is wrong or 1 is red. So long-term teams is good, medium-term is okay, short-term is safe. So that's what I would say from a market standpoint. Now that this has been the synopsis, if I were a person who has 5-year plus money, if I don't have 70-80% of my money in equity, especially for a mutual fund investor, which is anyways a risk mitigated tool, I would say that I will not be able to beat inflation. So 70-80% in equity is the most important decision. And most people in India don't have that. They iskaan se sunte hain, uskaan se nikal dete.
All right, fair enough. Now, before I get to the choice of the funds, the picks, once again, I just want to focus on the selection process and the whole framework that you need to follow. And Kaustubh, I know that you guys at Morningstar did an interesting study in terms of the performance of funds and their future track record. Tell us more about the study.
I think some interesting data that came out of it, right? The first thing we tracked was if I just try to correlate 1-year returns, right? Using the hypothesis that investors, there are a lot of new DIY investors who are making these choices on their own. There are obviously great, advisors and distributors like Feroze and his team who are helping investors make more nuanced choices. But there's a large segment of the industry who are making those choices themselves. And sometimes with the lack of a better alternative, looking at very short-term recent performance and investing.
So basically what you're saying is that we go to the Morningstar website, we check the year, 1-year return, 3-year return, 5-year return, and we see, oh, this fund has done really well for the last 5 years, so it must be a great fund. That's not a good approach.
Not a good approach at all. So what the data showed us was 2 very stark things, right? The first thing was that half the flows, if I just look at 2024, in fact, not even 24, we went back 5 years, and what we looked at was, over a 5-year period, if I just look at the monthly flows that came in, 50% of the flows came into quartile 1 funds ranked on a 1-year return. So if I was making a fund choice, I'll look at the past 1-year return. And this is within the diversified equity categories, right? We're not even getting into sectoral and thematics. And 50% of the money came into quartile 1 funds. Another 32% came into funds that didn't even have a 1-year track record. So, newer fund launches and things like that. So think of it this way, more than 80% of your flows are coming into funds that probably have done well recently or have just been launched recently. But the staggering extension to that is when you ran this data as of 2019 to 24. So if I was sitting in 2019 and I picked these quartile 1 funds, how many of those funds sitting in 24 were still quartile 1, right? So out of 10 funds, less than 3 funds still remained in quartile 1, right, on a 5-year time period. So the point that I'm making is that, well, performance can give you a sense of how a fund has done in the past, but it's not necessarily a surety that it's going to continue to do going well ahead, because there are various factors that you need to consider. So performance is good, perhaps way of shortlisting, risk-adjusted parameters, but, don't stop your analysis or base your decision purely based on that. I think that's what the study is resoundingly telling you, that, don't just pick the most recent short-term winner.
Which is really important, because we do need to understand, right, what these other factors are that we must consider. Even if you are taking an advisor or distributor's help to arrive at that fund selection, decision, it's good to have an informed discussion with your advisor and understand what actually you're investing in and whether it makes sense for you or not, right? So what are the other things apart from past performance that we must consider before buying a fund?
Sure. So, when we look at analyzing funds, right, there are 3 things we look at, and we call it the 3 Ps. So one is the people, the process, and the parent, right? So I'll get into each of these, some pointers that we can look at. So the people is obviously you want to look at who the fund manager is, the track record that they've kind of developed over a period of time. Perhaps if they're a new manager to that asset manager, what's been the track record managing similar strategies in the past. You would want to look at the support cost of them, because, while the manager is doing what they're doing in terms of they're the face of the strategy, there's a dedicated pool of analysts who are delivering that raw material in terms of ideas for them to, consistently kind of, generate that alpha for them, right? You want to see some things like bandwidth, because if a portfolio manager is managing too many strategies of differing types, can they, a person has only X number of hours that he or she can dedicate, right? So how are they kind of channelizing their time? Do they dedicate enough time for that? Then the second part, which is very important, is the investment process, right? What is the investment process of the strategy, and has it been consistently applied over a period of time? You don't want managers who are extremely fluid in terms of chasing market trends, because you could get it wrong both ways, right? So you want a process that has an edge, right, and is repeatable over market cycles. And there'll be periods where that process could underperform because maybe you have style headwinds. For instance, if you're a growth manager sitting today, you will underperform in a more value momentum driven market. But you stick to your style. That's good, because as growth, as and when it comes back, no one knows when, it will,
your style will work again.
Yeah. And there are a few things you can look at it, right? So you can look at the historical, what you call the style holdings or the size holdings of the manager in terms of how they allocate across market capitalizations between value, growth, and blend stocks. Are they adding too much cash in the portfolio, which could be a challenge with too much money coming in and they don't find enough ideas to deploy? Number of stock holdings, how concentrated or diversified their portfolio, is that changing over time, right? So you as an investor, you can look at all these data points and actually make a sense of, is it steady state or have things materially changed with the process?
All right, so now that is the framework, and we have understood it completely in terms of the things to keep in mind before we decide to buy into a fund. Now it is time for our guest top fund choices, and there are lots of categories to go over. So we are going to kick it off with the large cap category. Feroze, your picks, best large cap funds for 2025 and why?
Yes, my large cap pick is going to be a reasonably offbeat. Quant large cap is my pick, because in large cap to generate alpha, you have to be courageous, very, very courageous. You can't hug the benchmark like a Nifty or a Sensex and expect to generate alpha. The active weights is what is going to give you the alpha. If you're going to mirror the index, now, for example, if HDFC is 11% in Nifty, you can't be exactly 11%. Anything more or less is called an active weight. So a quant large cap has this strategy of picking up 17, 15, 18 stocks. In a large cap portfolio, I don't mind concentrating because it's a liquid counter. You can always in 2 hours get out of any of these top 20, 30 Nifty counters. So point one, I would want concentrated bets. I would want high conviction. I would want a smaller scheme so that he can be agile. So it passes that litmus test. And I also want a asset management company which believes not just in fundamentals, also gives 20, 30% respect to demand and supply. Markets are demand and supply. A stock could be great on fundamentals. It will be at 20 PE for the next 20 years. And there could be a stock which is at 60 PE at half the great fundamentals. So demand and supply, quant respects demand and supply. And Sandeep Tandon has been a treasury guy. And I've looked at his models. how he models risk and demand and supply, which is over and above the fundamentals a fund manager should ideally do in a market like that. And Kaustubh Saab is here. We also subscribe to Morningstar, and they give us a lot of information to understand who's the owner of the stock.
Kaustubh, what about you? What do you guys at Morningstar like in the large cap category?
Yeah, so for us, and I think Feroze made a very important point that large cap has become harder and harder to beat the benchmark. And if you're very, very, hugging the benchmark, it's going to be hard to consistently beat. So we have a couple of names that we like, and some of them may be what we visually, when you would look at it, you would say that they're closer to the benchmark. But let me share some theses around that. So one is, it's been an old favorite, the Aditya Birla Frontline. Now Mahesh is obviously a super experienced manager. I think from his perspective now, with the overall CIO role, he's kind of managing this particular strategy in entirety and not really got too much else in terms of fund management responsibilities, which is great. So he's got his focus there. While he is benchmark aware, I think he takes active bets in the underlying stock holdings, right? So he'll align sector portfolios in line with the benchmark, close to that, but his stock bets would be pretty active. And secondly, what he does is, because he's valuation conscious, as and when he believes that a stock's valuation has gone up excessively, he will trim some of his long-term holdings and potentially, if it corrects, buy it back. So that adds a potential element of alpha, and it's been a pretty reasonably consistent performer over a long period of time. Right? That's one. I think the other one that we like is the ICICI Prudential Blue Chip. Now Anish, again, now he runs a slightly differentiated strategy where what we call a barbell approach, right? So ICICI is traditionally always known as a value shop, given Narayan, obviously.
Because of Narayan's.
Yeah. So, but Anish comes from a slightly different school of thought. So obviously they've got a huge dedicated pool of analysts where he can get the ideas from in terms of fair value of stocks and what are the potentials for growth. So he will build what we call a barbell approach. So he will at one end buy high growth stocks, probably pay a little bit of a premium valuation, but the other end of the spectrum, he'll also buy fundamentally sound companies that are probably trading at lower than the regular valuations could be because of some negative news or something that's not baked in. So I think that again adds a fair bit of active management within the perspective of large caps, and I think that's another strategy that's done pretty well over extended periods of time.
All right, gentlemen, we're actually out of time on this particular edition, but viewers, worry not. We have only just gotten started. We've just covered the top large cap fund ideas for 2025. These two gentlemen, they're going to stay on with us because next week we bring you the part 2 of this series where we'll go over all the other categories, the top mid-cap funds, the small-cap funds, the flexi-cap funds, and even the tax-saving ELSS funds that you can pick for the new year 2025. Views from both Morningstar as well as Anand Rathi Private Wealth will continue. So keep your date with us. See you again on Let's Talk Money, same time, same place next week.
Let's Talk Money